Welcome to Looking at the Markets with David Moadel. Today we're going to talk about a really crucial topic, and I hope you're all listening to this. If you're not hedging, then you're not investing. So let's talk about it. Protecting against a stock market crash. How to hedge your investments. So why do you need to know about this? Well, here's why you need to protect your investments from market crashes. Here's a chart of the S&P 500 since the mid-1990s or so, up until 2016. And if you buy stocks, if you buy the S&P 500 at the wrong time, it's really bad. Okay, you might have to wait 6 or even 7 years just to break even, just to get your money back. Forget about a profit even, just to get your money back. For example, if you bought stocks here, and by the way, when the S&P 500 crashes, pretty much every stock or almost every stock goes down. So if you bought Apple, if you bought Microsoft, whatever, if you bought General Electric, Ford, Coca-Cola, pick any well-known stock. If you bought it and then the market crashed, you can pretty much count on your stock going down. When the market crashes, it takes almost every stock with it. So that's why I put an S&P 500 chart up here. If you bought the S&P 500 or pretty much any stock within the S&P 500 in 2000, right here in the year 2000, and then the market crashed, look how long it would take you just to get back to the break-even point. 7 years. And if you had bought here in the year in late 2007, it would have taken almost as long. It would have taken 6 years, again, just to not even make a profit, just to get your money back. And that whole time, you would have really been it would have been pretty bad, watching your money go down and down and down so fast, and then watching it slowly come back up over years and years. And that's if you had held on. I think most people probably did not hold on all this time. While it was crashing and crashing, they probably sold for a substantial loss. And the stock market went down about 50% here. You would have lost half your money. And then again, here, about 50%. That's a huge loss. And in fact, a big loss like that, like a 50% loss in your portfolio, would be more devastating than you probably think. Because if you lose 50% of your money in your trading or investing account, you need to double your money. You need to gain 100% of what you now have after the loss just to break even, just to get back to the break-even point. It's not bad if you lose only 5% of your money. I mean, it's bad to lose, of course, but you only need to gain a little bit over 5% just, to get back to break even. If you lose 10%, it's a problem, but it is possible to make your money back. You need to gain a little bit more than 11% to get of what you have after the loss to get back to break even. But when you start losing 15, 20, 25%, it's really an uphill battle, a major battle. And if you sustain a big loss like 50%, it's pretty devastating. And if you lose more than 50%, then it's incredibly difficult to get back to break even. I'm sure people have done it. It's possible, but the point is you don't want to sustain a really big loss if you can help it. So you need to be hedging in some way, shape, or form. So how do you do it? Well, there are a number of ways to hedge. And by hedge, I mean preventing a big loss. You can buy put options to protect the stocks or ETFs that you already own. You can use stop loss orders, and I have videos about a lot of these topics here. You can use small position sizes. in all of your trades. Whenever you buy or sell, just small amounts of your portfolio. Not, you don't put everything into one trade, or even half of your money into one trade. More like 5% or less. You can buy pairs of stocks or ETFs that offset or counterbalance each other. For example, if you buy a ticker SPY, which represents the S&P 500, but then you also buy some TLT, which represents treasuries or bonds. Or you might buy some SPY and some gold, which is represented by the ETF ticker GLD. You can buy small amounts of options, like puts or calls, instead of buying large amounts of stocks or ETFs. And for option sellers, you can hedge by using option spreads instead of just selling uncovered or naked options. And these are more advanced strategies here. And you can use more than one hedging strategy. Out of all the strategies I just listed, you can use more than one. It's not a bad idea at all. For example, you can use stop-loss orders and also use small position sizes in all of your trades. So what's the takeaway? Well, if you're not hedging, then you're not really investing, you're just gambling. So use one or more hedging strategies to keep yourself financially and emotionally stable. And there are other hedging strategies. I did not list all of them. I'm sure there are more, but those are the main ones that I've seen people use successfully. And if you'd like to learn more about this, or how to keep your investments and trades safe and reasonable and secure, or if you just want to put together a trading plan, I can certainly help you with that. My name is David Moadel, and my email address is davidmoadel@gmail.com, and you can email me at any time. And if you like this video, please give it a thumbs up on YouTube, leave a comment, I like to read your comments, and subscribe to my YouTube channel so you can receive the latest updates on my financial educational content. Thank you so much, and I hope to hear from you soon.